Go home and flip coins, and you can check my logic there. But that's why four, splitting into four, and also because it makes us think of cauliflower pizza. That's why that's a good idea.
I don't think that gets enough attention for how much guts that really does take.
Say 3 slices of your pie were all travel related or restaurant related. I don't care how good of an investor you were, you got dismantled. Your portfolio got dismantled.
For a lot of the people that we idolize, it's more about the game than it is the actual wealth generation at that point.
Yeah. Well, speak for yourself. I don't idolize them.
All right, folks. So welcome to Investing for Beginners podcast. Today we have episode 379. Today we're going to answer a great listener question that we got actually during one of our live webinars. We recently did a webinar on the semiconductor industry, and one of our members, Cheryl, asked this fantastic question where she basically asked us, how do we feel about sector concentration and how do we deal with that? At the time, we didn't feel like we had the greatest answer, but after some reflection, mostly on Andrew's part, we feel like we have a better answer. So we thought maybe we could just answer this on the air, and Cheryl will listen, hopefully, and all the other people that listen to our show will get an answer for this as well. So Andrew, do we want to talk maybe about where this sprouted from and how you kind of think about sector diversification?
Yeah, totally. We've obviously have tracked our journey as investors. You can hear it throughout the show. And so part of me learning about how I wanted to invest was what am I trying to achieve, and then what mistakes am I making along the way. At a certain point, I decided, for me personally, I don't want to be Warren Buffett. I don't think I have the skill set or expertise to be like him, to put 40-50% into American Express. And to be frank, I'm not trying to turn $100,000 into $2 billion, or what is it now? Probably 30 billion, 50 billion, whatever he's got.
Something crazy number.
So I don't need to take a risk like that of putting half of my portfolio into something, because I'm not trying to achieve what he achieved. And so that kind of starts the whole framework of, if that approach makes sense to you, where you want to have results that maybe beat the market, but it doesn't need to be Warren Buffett beating the market, then that allows you to take less risk and allows you to be a lot more wrong on stocks, by the way, which I think fits my skill set a little bit better, because I can be a little too much of a generalist. And so if you have enough diversification, and that includes with the sectors, it allows you that leeway to put yourself on the limb and make more mistakes. Like Buffett did in the early days. If this American Express trade doesn't work out, man, I'm going to basically have to start over. That can be a really hard place to be. By putting a framework in place of, okay, I'm putting guardrails on how much exposure I'm getting, that gives you less of that kind of having to start over risk. And so for me personally, that's very attractive, especially because my results are publicly posted. And so when I trail the market, everybody can see it.
Right. Yeah, for sure. I don't think that like his, what's the word I'm looking for? Daredevil-ism. I don't think that is really discussed a lot. I think when most people think of Buffett, they think of this super conservative investor, and he has taken some big gambles throughout his journey. And I don't think that gets enough attention for how much guts that really does take. Like you said, to put 40-50% of your portfolio in one position, like he did with American Express and like he did with Apple more recently. He didn't invest that much, but it got to that point. And those are hard decisions to make. And I think what you said earlier about realizing you're not Warren Buffett and you shouldn't invest like him, I think is a really good, we can learn a lot from Uncle Warren and Uncle Charlie for sure. But I think we all have to know kind of what game we're playing and how we're built. Some of us are built to take those 40% chances, and others, like myself, are not. And it's okay. That's okay to be like that and not to want to take those big swings. And it's interesting how he has changed a little bit over the years, but not really. So I guess a question I have then is, how do you think about, like, when you're building the portfolio, how do you think about portfolio construction and some sort of diversification, or how do you kind of put that together?
Yeah, it's definitely been a living, breathing beast.
Mhm.
And so I would say the latest evolution of it I've come up with in the last 12 months or so. And again, I feel like it fits what I'm trying to do. And it could evolve a little bit moving forward, but it feels a lot more sound, I guess. Because I started with the idea of 15 to 20 stocks in my portfolio. And I think that's a great place for most people. And honestly, we could probably just cut it there, except for the sector part. We'll get to the sector part, but I'm just talking about building the diversification base. And that served me well for a while. And then I realized I'm running a public newsletter portfolio. So I need to think differently. And so that's evolved over time. And the way I think of it now is having sizes of bets or positions that are conducive to giving me some upside, but also reducing my downside. And then as it relates to this sector concentration, which, like you said, Cheryl, that was awesome that she brought this up because we can really get in the weeds of this. But thinking of it as or splitting it into four sections. So if we have the pie, cut it. It's like your cauliflower pizza.
You're right.
It's just
Yeah.
small enough where you cut into 4 slices, and that's a perfect size.
Yeah.
So let's envision our portfolio that way with the sectors, and maybe less so sectors, but even just like general themes. But if we split into 4, that does some pretty cool things, because you can check my math on this. It's a little bit of probability 101, but if you took 3 coins and if you took 4 coins, and if you flip those 100 times, your 4 coins would break even a lot more than your 3 coins would. So go home and flip coins, and you can check my logic there. But that's why 4, splitting into 4, and also because it makes us think of cauliflower pizza. That's why that's a good idea. And so within those 4, you probably want to have different themes that reduce the chance that something that you're not expecting really wipes out your portfolio, makes it hard to come back from. An example, which is very relevant for all of us recently, when COVID hit, if you had, let's say, 3 slices of your pie were all travel related or restaurant related, I don't care how good of an investor you were, you got dismantled. Your portfolio got dismantled. So that's what we're trying to avoid, because life is so uncertain, and even an entire sector can get whacked. And so that's why we have diversification within sectors or themes.
Mhm.
What are your thoughts on that? How do you see kind of sectors or themes?
I definitely agree that you need to, as part of kind of trying to diversify your portfolio, is having it broken up into those buckets, if you will. And I like the idea of doing it that way, because then it not only helps force you to stay within those kind of buckets or sectors, it also helps you, I think, focus more on the places that you feel comfortable investing. I think one of the things that I think about is when I've built my portfolio, is I went down the payments rabbit hole, and we've talked about this in the past, and I got too much into the diversification, or not too, I got too focused. And I think that can be just as dangerous as having too much, too broad of a generalist you were talking about earlier. I think that can be dangerous too, but it's also having too much focus on one particular sector can be harmful to your returns, especially if it continues. And having all of your eggs in one basket, I think, is not a great place to be. And I'm not Warren Buffett. I can't have concentration like he does, just because I'm not built that way. And so for me, having some sort of diversification is kind of a must.
Are there, like, how would you categorize sectors or themes? Like, would you use the S&P 500's sector categorization to do that?
That's a good question. I think that's probably not a bad place to start, is that to have the general themes that are expressed in something like the S&P 500, and then kind of you could break it down further from there. I mean, the world's your oyster, right? If you want to really go nuts and have like subcategories of subcategories, you could probably go crazy. But I think just as a general rule, having those sectors as kind of an overview, I think is a good place to start. What are your thoughts?
Yeah. Um, I'm kind of in the camp of like, so I'll use home building like I do a million times. Put a sticker on your wall for every time I do by the end of the year. Home building. So I think of the stocks that are exposed to home building. You have PulteGroup, obviously, will be consumer cyclical sector, and then something like UFP Technologies, or I'm sorry, UFP Industries. That's more basic materials, but they're very tied to home building also. And then something like Builders First Source, which is technically an industrial, but they're a major supplier to home builders. So, payments is another good example. I don't know what PayPal are they called tech or are they called financials? I'm not sure, but I would try to put the PayPals of the world in the payments bucket rather than just something else. Like tech. I think tech is one of those that gets really, it's just like this general
Murky.
bucket a lot of things get thrown into, but I don't know. I mean, Google versus Amazon, not really similar exposures necessarily. I think of Google more like, and Google actually, Alphabet's not in the tech bucket, but you can apply it to some of the other bigger ones. Apple, I guess. The challenges for Google and the challenges for Apple are not going to be the same, even if they're both in investors' minds thought of as tech.
I think that's a challenge of investing in air quote the tech industry, is what do you lump as tech and what do you lump as other things?
Yeah.
To your point, Alphabet certainly has some tech parts to it. You could argue that Google Cloud or the AI stuff that they're doing is tech related, but the majority of their income comes from advertising. And that's, I mean, it's kind of tech, but it's not. And I guess I feel like maybe a company like Microsoft would definitely fall more in the tech camp than maybe Alphabet or Google does. And Amazon is kind of a beast of its own, because you have all that retail, then you also have the AWS tech part of it, and then you have the infrastructure part of it. And so it's just kind of an amalgamation of a lot of different things. And so that could make it hard. But I think you could lump a company like CrowdStrike into the tech part of it. Sometimes the categories can be kind of wide. You were talking about payments earlier. Payments, if you think about payments, they really are financials, but you could also argue that Visa is not like JP Morgan, but they're both financials in technically, but PayPal could definitely straddle both. It could be pretty broad based when you I think when you lump some of these different sectors, there's a lot of different moving parts within those, and some of them can straddle both parts of, or different parts of different sectors and whatnot, which can make it interesting. I think if you're trying to think black and white, like this is home building and this is this and this is this, it might be a little harder to do than you think. But I think as a general rule, I think that, I mean, I like the idea of having things kind of bucketed into themes. I think that makes it easier. I think the word sector sometimes can be a little defining, and maybe an idea like a theme can be a little more broad.
Yeah, totally. I guess when I try to think of how I apply it personally, It's like you said, it's not really black and white, though. I guess somebody could make it that way if they want to. More so, just trying to keep cognizant of it. Um, I'm certainly not going through every stock in my portfolio and thinking about is it this or is it that.
Right.
But when I look at my biggest positions, right now, Alphabet, Crown Castle, Pulte Group, are all three of those in one bucket, or does it sound reasonable that they're in separate buckets?
Mm.
And that's how I try to apply it personally, and hopefully that's helpful for somebody out there.
Yeah, I'm sure it is. So, do you think that this is something that naturally evolves, or is it something that people should like having things in these four themes, for example, and trying to build your portfolio kind of around that? Do you think that's a way that you can learn, or is that something that is something evolves as you grow as an investor?
I love that question. That's fantastic. And so I'm gonna answer it with another one of our favorite things to say.
Okay.
So on your other wall, it depends. Yes. Put stickers on your wall for every time we say that. So yeah, I mean it depends. Like if you're in a place where you can't really stomach a lot of volatility. Like if you're rolling over a Roth IRA, for example, I think is a good example. I remember when I had to do that very early in my career, and it was like 20 grand and it felt like a lot. And so I didn't want to just I wanted diversification right off the bat. And so, dollar cost average it over 10 months, and then having the different themes. So I'm not doing the same theme over and over again. I think in that case would make sense to roll over Andrew back in the day. But if you have somebody who's just starting in their investing and it's a couple $100 and they're got 30-40 years down the line, and it's more about just learning how to be an investor versus like this is money I need to build like a diversified portfolio with, then maybe in that case it's not something to worry about until down the road. So I think you can go anywhere between that spectrum of depends on you and what you're comfortable with. But certainly once you get to a certain size where you might depend on this in the future, I think it's becomes increasingly important.
Yeah, it definitely becomes increasingly important. How would you, so let's say that we're use easy numbers. If we have 20 stocks and we're kind of looking at four different themes or buckets, how would you think about adding one outside of that? So in other words, if you have 20 companies and you're like, okay, this is my portfolio is 20, but you come across, the next Amazon, for example, and maybe that breaks the cycle or puts you outside of one of those buckets. How would you approach that?
So I think I'm not describing it great. So when I say the buckets, I really mean like a max slice. So like if I have home building on one slice and then let's say payments on another slice, so we're filled 2 of 4, and then that third slice could literally be a million different slices. Yeah. So I wouldn't think of it in that way when I'm trying to talk about a framework to have guardrails. I just mean like your max exposure.
Okay.
Yep.
All right. That makes sense. All right. Do you feel like the max exposure to those sectors are things that you will gravitate towards over time, or how do you feel about maybe trying to expand on those? Like is the third rail, if you will, is that the one where you can just kind of be more miscellaneous and step outside of those sectors or frameworks?
Yeah, for sure.
Okay.
Yeah.
All right.
I do think it's interesting. You talk about kind of this changing of time or this movement of time. It's interesting if you start, let's say 25% into a company, which I feel like is not like that's a pretty common thing for a lot of investors to talk about. Like what happens if you are actually right? like God forbid you're actually right and you made a great choice,
Mm.
and now your stock's at half of your portfolio. Like, how much time are you using questioning every day? Is that too much exposure? You know? So that's another thing to keep in mind. Like, if with concentration, if you do concentration right, you're going to get more concentrated over time.
Mm.
And this is something that's made Brian Feraldi's approach increasingly attractive to me, is he's talked about, and he's done this since like 2010, I think.
Yeah.
He's had some really nice winners, and those big winners like Netflix, I think, was one, Tesla was one. Those winners started small and then grew into significant sizes. And I think today, because he just does this cool YouTube video about his strategy for 2025. Go check it out if you haven't yet. But he kind of showed a pie, I believe, and it showed his different exposures to different stocks. And so even something like Netflix or Tesla, even though it grew like, I think Netflix is up like 4,000% or something for him, it still is only 6 or 7% of his portfolio. So my point in saying all that is, you start small enough and then you let them ride. And as long as you didn't concentrate too much in the beginning, you don't have to question yourself down the line, like, is this the point where I sell? Because that can be a miserable thing. And so one of the benefits to having that bigger diversification is it kicks that can down the road. You don't have to have a position that does so well it grows into a huge position, and now you got to figure out what you want to do with it.
Mm-hmm. That's a great point. How much do you think newer investors should spend thinking on portfolio sizing / diversification?
Yeah, probably not much. Definitely talking as somebody who's been doing this a while and has to think about that. I just go back to my comments earlier. If you're putting money in where you're feeling that, then you should think about portfolio management. And if you're still in the builder stage and you're not feeling it, then don't worry. Just get out there and put some skin in the game.
Yeah. I mean, we all start with 100% concentration, right? Like if you buy one company, buy one stock, whether it's $50 or $1,000, it's still 100%. Yeah. And then, as you add more to the portfolio, then it starts to become different levels of the portfolio. So, I mean, we all start at 100% and then kind of go from there. Do you think concentration is something that is innate in people's persona, or is it something maybe they learn as they get more experience?
That's an interesting thought. Learning as in, like, just quantify that last part for me real quick.
Yeah, lots of famous investors have wide ranges of, Joel Greenblatt has hundreds of companies. Charlie Munger had 4 when he passed away. There's this wide range of different, concentrations, if you will. Peter Lynch had, thousands of stocks. Michael Burry had, half a dozen at one time. Monish Pabrai has gone from large amounts to small amounts. I wonder if, for myself, as I get older and I hold companies for longer, I wonder if my concentration starts to shrink because, or not, maybe that shrink's not the right word, but maybe instead of running with 30 companies, maybe I run with 12 because I know these 12 really, really well and I've known them for a really long time. And I wonder if that is a natural evolution, or if that's something that just some people are just born with, hey, I can roll with 4 or 5 companies and I'm good with it, or others need to have more baskets.
I think it's both. As it comes to getting close to retirement or something like that, that's outside of my circle of competence. I would probably talk to a financial advisor or financial planner. And I do think some people have more of the gusto, but I also think a lot of the investors that people idolize, a lot of them are already financially secure. Right. So and I'm not saying this is the case for Warren Buffett, because he takes his stewardship of Berkshire Hathaway seriously. But there are some other investors, if they're just trying to chase fame or chase, like, look at me, I've outperformed all of you, they might be completely fine taking those kinds of bets
Mm.
and not really having a personal impact because they're already financially independent. So I think that's a factor too. And when I'm talking to this broad audience, I think for average investors who maybe work hard for their money, they should take these investors that people idolize who concentrate with a grain of salt because it's a lot of confirmation bias.
Yeah.
Not confirmation, survivorship bias.
Mhm.
We only hear about the people who do it well. We don't hear about the people who tried and failed doing
Right.
that.
Yes. Yep. For sure. Yeah. I think about investors like Stanley Druckenmiller who have had a lot of success, and so to your point, the way that they invest is different than the way you and I would have to invest because he's already financially secure, so he could not, or he could take bigger chances if he wants to or not, just depending on what he's trying to do with his portfolio. I think for a lot of the people that we idolize, it's more about the game than it is the actual wealth generation at that point.
Yeah. Well, speak for yourself. I don't idolize them.
Maybe look up to. How's that? Is that a better way
Right.
of putting it?
Yeah.
Look up to and are trying to learn from. A lot of those people, a lot of the people that we certainly follow they have achieved financial success in one way, shape, or form. And I think to them it's more about the game now.
Oh yeah, 100%. And it's crazy that that's Wall Street.
Right.
It is what it is.
Yes, I agree. Do you have any other final thoughts about diversification and portfolio maintenance, and maybe how to look at the different sectors or buckets or themes that you want to put your investments in?
I think that pretty much covers it for me. What about for you?
I think so. I think one thing I would probably encourage people is when you're thinking about when you are starting to build your portfolio, try not to get too caught up in the I have to fill every sector bucket kind of idea and buy gold just because I need to have a commodity, for example. There are portfolios out there that do that for sure. Ray Dalio has a portfolio like that, an all-weather type portfolio, and that's one way to invest for sure. But I think try not to just hunt for I got to have this sector and I got to fill it with this kind of thing. It's better to pick better companies than to just try to fill a slot.
100% agree with that. I think that's very well said. Well, thank you for listening and supporting the show. We appreciate all of your questions and feedback as always. I hope this was an enlightening conversation. If not, sorry, no refunds on your time. Take action today, connect, learn, and grow with Value Spotlight. Peace.